Deep Securities Research, and we are pleased and honored to have the CEO and CFO of Prime with us. So the CEO is Mr. Rahul Rana, and the CFO is Miss Cindy Teo. Yeah, just some quick housekeeping rules before we begin. There's a Q&A tab at the bottom, so please feel free to just type in any questions you might have into the question and answer tab, and the management will get to those questions right after the presentation. Yep, so without any further ado, let me hand over the time now to Rahul. Yeah, Rahul, please.
Yeah,
Thank you.
Thank you, Darren. My name is Rahul Rana. I am the CEO and co-sponsor of Prime US REIT. I really appreciate you taking your time to dial in and listening to our key business and operational updates. So I'm just going to start by talking a little bit about US office and the environment in the United States of America. So as we all know, the office market in America is large and wide, very complex, and an evolving office environment. So what's critical to understand is how there's a flight to quality. What I mean is Class C, Class B buildings are doing really poorly, and a lot of tenants leaving those buildings to come into Class A and trophy assets. So we are fortunate to have Class A buildings in these various submarkets that we are in. And I'm happy to report that demand is bouncing back. We are signing large tenant leases, and we're seeing a lot of activity in most of our submarkets. It's a net negative inventory environment, which means new construction is not coming to the market because construction loans are not available. So new supply is limited or almost zero in the submarkets that we are in. And the vacancy that existed is declining. The vacancy means occupancy is getting better. Like I mentioned, the flight of quality. So for the Class A buildings that are a vintage of 2000 handle, right, are seeing vacancy declines, and that trend is getting better and better. And the outlook for next year is pretty robust. And for these Class A assets, there is participation from US banks and debt funds that has starting to show signs where people are selling and buying buildings, which is possible through financings available from banks. So trophy assets and Class A assets where there's activity coming back. And, we have a declining interest rate environment in the US, which is giving some kind of, how should I say, it's creating some tailwinds in commercial real estate. And it gives corporate tenants the courage to sign long-term leases. The economy is growing. Corporate profits are healthy. Yes, there are some layoffs happening, but that's more of a recalibration based on the impact of AI. So the labor markets are weak, but there's inflationary pressures that are, creating kind of growth. So there's enough liquidity in the US. And what I'm also seeing is a lot of debt hedge funds like Apollo and Ares and KKR have raised billions of dollars to do credit lending towards corporate America and commercial real estate assets like ours. So these are the so-called macro events that are happening in the US. So the future looks encouraging, and occupancy levels are getting better. So just talking about Prime, occupancy level is at 80.7 as of June 2025. We will end the year much higher than this number because we are completing 3 big leases. And in the coming month, we should be able to announce that the completion of these leases. I'm pleased to say that our WALE has gone from 4.7 to 4.9 because the tenants we're engaging with are partners of ours. The new tenants coming in, they want to sign 10, 11-year leases. We are very premeditated in choosing tenants that want to sign long-term leases because we spend money bringing them in terms of tenant improvement, and we get some rent-free in the earlier months. And so from a cost or return on investment perspective, long-term leases make sense. And also a longer WALE allows us to borrow cheaper money. So you get cheaper money, it helps in a larger distribution pool, right? Rental reversion is healthy. In 2025, second quarter, we signed 92,000 square feet, and that momentum is going to be even higher by the third and fourth quarter of this year. Our leverage is at 44.9, NAV at 52, and I'm very pleased to say to all of you that we have a distributable income payout increase from 10% to at least 50% starting from the second half of 2025. So with these comments, I would now like to turn over to our CFO, who's going to walk you through the book, the balance of the book. Cindy Teo.
Thanks, Rahul. So good afternoon, everyone. Thank you for joining us. I'm Cindy, the CFO of Prime US REIT. So today we'll walk you through Prime's performance and the updates for the third quarter 2025. So over here at slide 4, leasing momentum has improved considerably and committed occupancy has increased to 80.7% compared to the lowest point we had in March. So although there is some volatility in the P&L due to some vacates this quarter, but because majority of the leases on the backfill space have not commenced rent yet, and with the high degree of visibility in the future contractual cash flow, we believe it is reasonable to start normalizing the distribution policy. So we completed a 25 million equity placement in October. I can see in the next slide. Seeing the vast improvement in the leasing momentum. So this capital raise is primarily to fund the capital needs. The money goes back to the asset to fund the tenants' improvements to protect long-term value of the unit holders. With a strengthened balance sheet, we are in a better position to increase the payout ratio to at least 50% and had declared an advanced distribution per unit of 0.24 cents based on 50% payout. So as the rent payment or the new leases start, we can expect further growth in the property cash income generated, improving the recurring income base. So moving on to the next slide. Now, this slide is something we have shown since first quarter, and we are happy to share that things are getting better and better. So on the left, we are looking at further occupancy gain at end of this week. So as an update, we have moved on to lease drafting stage for at least 150,000 square feet. So over on the right, the number is increasing as well. So out of the 80.7% committed occupancy as at 30th September, there is still about 10.8% that has not commenced rent but are locked in. So we are tracking this square footage that are lining up pending commencement when the renovation is done. So these are committed spaces that will turn income generating, and about 673,000 square feet of new leases that were signed so far and is included in the occupancy rate. But if you look at the green one, so only about 220,000 square feet had commenced rent, i.e. these rents, these leases have started to flow into the distributable income. So there is a time lag of probably about 12 months or so. So 452,000 square feet of space is still in their rent-free fitting out period. This shows the square footage of cash flow that is already locked in to date. So I'll move on to look at the occupancy for each asset. Overall portfolio occupancy has increased to 80.7 as at September. So just zooming into a few assets that we should focus on. I'll start with 222 Main. We highlighted in the last quarter that occupancy will drop due to space recalibration of Goldman, where they move out 3 floors. But with the signing of 61,000 square feet with USAO, the Utah district last month, occupancy is back to above 90%. So over at the other asset, Waterfront and Washingtonian, this is the asset that underwent AEI works last year and was completed in October. So we improved the occupancy from 33% pre-reno to 85% in June, and this quarter occupancy improved further to 87% with a new lease signing. At Promenade, we are also happy to share a 10,000 square feet lease signed with UBS, and occupancy has improved to above 85%. So another asset that has a lot of activities is Village Center Station 1 at Denver. So it has been hovering at the 50% range in 2024. So in this quarter, we see that there's a slight dip, but we had to downsize the existing tenant to reconfigure the space and make way for incoming prospect, which we expect to sign this financial service company very soon. After which, this building will only be left with about 1.5 floor, and we are already in discussion with another prospect to take over the space. And over at Park Tower, this 120,000 square foot lease has reached a fine-tuning stage. We believe it will be closed soon by end of this year as well. So moving on to the next slide on expiries. So we summarize the stack on the lease expiries for each year. We have completed a total of 490,000 square feet for the first 9 months, and I'm very happy to share that rent reversion is positive and achieve a 6% for year to date. WALE has increased further to 4.9 years. So moving on, slide 9. So we will see here there is a top 10 tenants. This shows the sector diversification that we have. And the nature of the industry you can see is pretty shielded from the tariffs impact, and it's a good mix of the industry. So there's some movement up, for example, because medicine, they actually increased or rather expanded their space with us, which is why there's a shifting of them up in the top 10. So moving on to next on balance sheet. Liquidity is very important in business and even more important in today's environment. So with the capital requirements or the tenants improvement works, the equity fundraise that we did cannot be more timely enough to give us a boost in the liquidity. So financial discipline is a cornerstone in the way we carry on the business. So as at 30th September, we have 58 million undrawn committed revolver credit line. This have not considered the equity fundraise that we had. So with this revolver line, it actually opens up conversations and differentiates Prime from the others. There is no debt maturing in 2025, and we have a small tranche, 70 million next year, which is secured over Sorrento, and this will be refinanced. So about 66% of our borrowings are either hedged or at fixed rate. Leverage and ICR are also within MAS limits as well. So with that, let me hand over back to Rahul to give you share more colors with you. Rahul?
Sorry, a little technical glitch. Thank you, Cindy. So it's important that when we engage with these large global name prospect tenants, right? The days of today, they look at the credit worthiness of the landlord. Before, it used to be us doing credit checks on the tenant. So maintaining a solid and liquid balance sheet is super, super important while these conversations begin, because this we start is a partnership with our tenants. So that's why getting our refinancing done, getting working capital lines, and having the debt headroom that we have, doing an EFR, are all events that are leading to this so-called success in leasing. And we approach all of this with a great deal of capital discipline, with the intention of enhancing our top line, our property income growth, and addressing all our needs of our existing tenants, as they're the most important people in the room. We interact through our property managers with them at least on a weekly basis. We get feedback from them, whatever changes they're looking to make. So tenant retention is super important, because all these extensions come up, and so I want the experience to be fantastic in our buildings. Our plan is to, obviously, we are doing this with a goal in mind, which is to enhance distributable income payout. So we are, performing well this year. We'll carry that momentum well into 2026. And so the future is looking positive. And I will stop now and look to take any questions that you may have. And with that, Darren, I'll turn it over to you.
Yeah, thanks, Rahul and Cindy, for the presentation. Yeah, we have many, many questions. Yeah, so the first one is, in the flight to quality, are the tenants moving to Class A offices usually renting similar square footage as they did in the lower class offices?
Well, it's mixed, right? So, for example, in our Denver asset, the global financial institution whose lease we are in the process of signing, they're moving from a 60,000 square feet into which, they're in a space which is more warehouse-like type of entity. They're moving to a brighter, more modern building, but they're taking less space. Now, the client or the tenant we signed in Washingtonian for 120,000 square feet, they're growing. It's a new economy tenant. They already come back to us, and we are space planning for them for growth to accommodate more expansion. So it depends on the client. Financial services and law firms are expanding. We've seen some cases, and we can. Cindy, maybe you want to just highlight what we did for Madison and others here. AGG.
Oh. Okay, so for rental, we have so it depends on the tenant specifically. The key thing is moving into a quality assets, and this is a key point to attract their employees back to work. So we have seen cases like last year, in third quarter, we also announced a lease where the tenant had downsized. They had spent like don't know how many decades in downtown St. Louis and taking like 100,000 square feet of space, and they moved over to our Clayton asset, a bit a smaller space, but the rent in a way has not compromised, or rather, they are willing to take out a smaller space but willing to pay a higher rent. So that's something that we see for that particular firm. But we also see firms where they are quite aggressively expanding. So it is very bifurcated. But the key thing is you need the quality assets in order to attract tenants. And the reason why is really because they want their employees to come back to the office. And so the quality is important for assets.
Okay. Yeah. How do these banks analyze whether they should finance?
Oh, it's they're very obsessed with cash flow and certainty of cash flow going forward. The tenant mix the vintage of the building, how much money you've put in, and what is the trend of occupancy and your LTV ratios and your interest coverage ratios. So, because of our quality of our assets, so a typical, we have floor plates of like 24,000, right, in Atlanta, building. So that attracts a very higher quality tenant because they're looking for that kind of floor plate, right? These are not these 5,000 here, 3,000 there. So it's contiguous kind of space with amenities, a gym, walkability to restaurants. Our Atlanta asset is very close to Atlantic Station. That creates the commuters that come from suburbs, and you just walk straight into a building, a 5-minute walk through undercover, right? Safety is a big thing that we focus on. A security guard, turnstiles, and we want and restaurants. So we want to give our tenants. So when the employees come to work, they feel good about it. There's good collaboration. There are places to go sit down and eat and meet and talk. We have beer Fridays. A lot of events we do for tenant engagement and all that. Yeah.
Okay. Yep. The next question is, are there any major leases that are expiring soon?
Soon, how do you define soon, Darren? Like
Yeah, perhaps let's talk about 1 year, within 1 year.
No, nothing major.
Yeah. If you look at the lease expiry stack, actually 2026, we have a very low bar. Yeah.
Okay, I see. Yeah, that's good to hear. Yeah, why was the third quarter leases signed only 92,000 square foot, which is a bit low compared to the last quarter?
It's more about a timing issue. So we have another 150,000 that is in the pipeline, and that will spur the leasing activity in the last quarter.
Yeah,
Okay.
it's not pipeline, it's closing, yeah.
Yeah.
Okay. Okay, so with that, can we expect the occupancy to increase to 85% by the end of the year?
Yes.
Good news, very good news. What drove the strong 14% rental reversions this quarter?
For this quarter, it's also predominantly by the lease that we signed at 222 Main. So Goldman exited, they were with us, I think about 15 years ago. So the lease back then, the rental rates was pretty low 15 years ago. And as it slowly climbs up, but now with the signing of the new leases at current market rate, actually that's the key thing that drove the rental rates.
Okay,
Rental reversion, yeah.
I see. What is the cost of debt we can expect after the refinancing in 2026?
Currently,
No.
go ahead.
So our financing structure is till 2027, Darren. We have the ability to extend in 2026.
Okay.
But I'll just make a few comments. For Class A product and quality asset, there are a lot of alternatives, right? One is you can do a takeout of a term CMBS structure or a SASB structure, where you take these assets and you issue a bond against them, and typically 3 years to 5 years. So if your WALE is long, you can the longer maturity, and you can get better cost of debt, if you will, right? Then banking relationships that we have, very happy with the results we performed because our cash flows are getting much better each year, right? So in 2027, it's a very, very good outcome. In 2026, we've given some rent-free, and these are all contracted numbers, right? And so we'll see the cash flow. So lenders take comfort from that. We have many different options, but we don't need to do anything for a big facility till 2027. Sorrento has a refinancing coming up, which is Sorrento Towers. We have a refinancing coming up July of next year, but we are in conversation with the lenders, and they're very happy with the occupancy in the 90s, mid-90s, right? So, and it's a solid tenant, Dexcom, that's in that building. So we should have no issue with that at all.
Okay, so right now the all-in average interest rate is 5.4%, the cost of debt. So perhaps any guidance after the so-called refinancing of the Sorrento debt?
Well, Darren, it's hard to give you a number, right? Because we do know that interest rate environment is declining. There's a 60% chance that the Federal Reserve cuts in December, and there's a much higher chance that there'll be at least 3 to 5 cuts in 2026, right? So the environment is decreasing interest rate environment, and the amount of money that has been raised, like I was saying, through debt funds and the deep capital markets in the US to absorb CMBS will drive down the spreads also, right? So it's hard for me to give you a number, but just for modeling purposes, you can use sub 6, for now. Yeah.
Okay. Okay, the next question is a long one. Will Prime REIT be looking to cap the amount of windfall in performance fees due to the change in payout ratio from 10% to 50%? So this is similar to what Keppel Pacific Oak CEO promised to unit holders when Core restarts distribution. The manager will make recommendations to the board to avoid a situation that would allow the manager to enjoy a so-called a windfall performance fee. Yep.
Sorry, I don't know what Core is saying or doing, right? For us, Darren, it's a board decision that we'll have to make, and we can let you know what the decision is. Yeah.
Okay. Okay, there are 50% of hedges that will fall off in 2026. How will that impact the cost of debt, and what are the plans for this fixed rate debt?
Yeah, so we continue to monitor the interest rate environment, the forward swap curve, and all that. We are in conversations on addressing the hedge between July of 26 to July of 27. And the various strategies we can employ: interest rate swap, zero cost collar, or a cap. So, we are in discussions on that right now.
Okay. What was the use of proceeds for the 30 million capex?
Majority actually went into doing the tenants improvement works for the new leases that were signed, so that once this renovation work is done, the rent can kickstart.
Okay. What does contribution by carrying value mean?
It's actually the asset value as at 30th September over the total portfolio asset value.
Okay, so the next question is the underperforming assets in terms of occupancy are those that have higher carrying value. So what is management expectations for the year-end valuation?
Well, so Darren, there's certain things in our control and certain things not in our control, right? The valuation process is run by third-party valuers. We put in all our inputs and comments and all that. So what's working for us is occupancy is getting much better, cash flow healthier, tenant mix getting better, longer Whale. We are upgrading the quality of our assets. So all the interest rate environment or discount rate used by valuers is decreasing. So that's all in our favor, right? But there have been, let's say, last year or this year, some distressed sellers because they were forced to sell in some of the markets that we are in. So that creates an ugly comp set, right? But I think the valuers are smart enough to realize that that was a distressed seller and all that. So we're hoping that it will be positive, the valuation. But it's too early for me to give you a precise answer.
Okay, understand. Yeah, the Park Tower negotiations have dragged on for a year, I believe, with no income. How can the REIT protect itself in such scenarios in the future? Can the lease discussion period be shortened?
Yes, you're absolutely correct. The discussions have got delayed, but the reason for the delay, this should have been signed mid-year, but it's going to be signed before year end. It's all complete, right? So just know that. The reason for the delay was because they wanted more space. So it's a state entity that is consolidating the office space. So they miscalculated on how much they wanted. They wanted more, which we had to reconfigure to accommodate that. That's the delay.
Okay.
And
With over
going forward, lease negotiations don't take this long. This is an exception because it's fragmented government offices all over the place. This was a big project, but we're happy to have them come into our building.
okay. With over 450,000 square foot of new leases pending rent commencement, how will this translate into DI growth in FY 2026?
I think because majority of the leases are only commenced towards the second half of 2026, I would still expect the distributable income to be relatively muted. But when we move into 2027, where the new leases have commenced the true full year, that's when we can see a very huge jump in the distributable income for 2027. 2026, it will be a slowly pick up, and towards the third quarter and fourth quarter, that's when we see a slowly increase.
Okay. Yeah, the next question is, with the nature of giving rent-free period of new leases and the need to have cash to perform TIs for new contracts signed in the next 6 to 12 months, does Prime foresee that it will face a cash crunch and that its existing debt headroom is unable to cover the entire cash needs and hence another round of share placement or rights issue?
No, we did the share placement. I think we did. Given the activity we have to do in terms of capex next year, which will be north of about $15 million, we have enough room, debt headroom, and cash to be able to enable that, right? So, and earlier I talked about prudent balance sheet. This is what I mean, right? We're not spending endlessly. When we spend and we give free rent, we're signing long-term leases and having the tenant sign above market rate rents. So that in turn helps the valuation. That in turn helps the leverage. That in turn helps, so it's a circle we understand well. And so it's not like we'll be in a cash crunch. So our plan is we are in a true path to stabilization. That's my phrase. True calculated path to stabilization.
Okay. Yeah, how much is the space being discussed under the 3 long-term leases that are expected to be completed by the end of 2025?
More than 150,000 square feet.
Okay. What is the reason for the big drop in MPI in third quarter 2025 versus earlier quarters?
There's some vacates that happened in this quarter, although the space was backfilled, but because the lease of all these new leases have not commenced, it's not a back-to-back kind of rental contribution at the same time, which is why there will be a dip in 3Q.
Okay. Does rental reversions include rent-free period?
No, the way we compute the rental reversion is based on the final year rent of the existing tenant versus the first year rent of the new incoming tenant.
Okay. Has rental bottomed in third quarter 2025?
Rental is in
I think this question is asking about rental rates, or maybe the attendee can clarify. Yeah. Okay, then we'll just skip that first. Okay, so next question is, what are the conditions required to be observed for management to increase distribution to more than 50% instead of just 50%?
Well, we are aspiring to do at least 50%, starting from the second half of 2025. And yeah, that's our aspiration. We want to do more than 50%. Yes.
Okay, so like what are the metrics that we see that we can monitor on our end to before that the distribution can be increased higher than this 50%?
I would say committed occupancy rate, because that gives us a greater visibility and a run rate of the cash flow that is flowing in. Yeah. But like what Rahul has said, the aspiration is really to be more than 50%.
Okay. Yeah, so a follow-up question is, how sustainable is this 50%, and under what conditions might you revert back to a lower payout ratio?
So this is a very calibrated kind of payout ratio. Once we go up, we definitely will not want to go it back to the level again. But sustainable, I think it depends on the visibility of the cash flow that we are having. So 50% is something that we are comfortable, and more than 50% is something that we're working towards too.
Okay. Yeah, the next question is, are US tenants open to purchasing office space, hence unlocking immediate liquidity and value? And is Prime open to selling like Hong Kong Land did when they sold some floor space to Hong Kong Exchange?
I'm sorry, Darren, let me understand your question. What is the question? Do US tenants what?
Whether your US tenants, are they open to purchasing office space from you guys? Yeah,
Oh,
like some floor space, maybe not the whole building, like just maybe
No,
one floor or something.
we are not in that business, Darren. We're in the rent collection business, not selling space. Either we sell the whole asset or we buy an asset. We're not selling piecemeal. You mean floors or floor space? Yeah.
Yes.
No.
Okay. Yeah, that's clear. Yeah, regarding the placement, what could explain the low end of the recent placement price?
you mean why the placement was issued at the lower end range of the price, is it?
Yes, that's a question from Ellen. Yeah, thanks.
Okay. It's more about the demand, and because of where we can land. Given that we are working along this band, I think this is a good band or value that it can translate to the subscribers as well.
Well, I mean, it's also, look, when we're doing an equity capital raise, right? We got in investors that believed in the story, and saw the future and the healthier cash flow going forward. And but we got to be cognizant to the current market situation and liquidity. So that leads to discounts. Yeah. Would we have liked to do it with zero discount? Yes. but the market was not there to execute that. Yeah.
Okay. Will there be significant changes to your major tenant list in FY 2026? What are the major sectors that your tenants are in FY 2026?
Well, when we sign this big lease, so you'll see one name come up and the other one drop off, right? So that will be one change. So in 2026, Cindy, is there any other change other than one name coming out and one dropping off?
Yeah, because 2026 there will be a new list of tenants that is starting their leases. So we will expect some movement, especially in the top 10 list. Yeah.
Yeah, one or two names, yes.
Okay.
But for
What
good
else?
reasons, not for bad reasons. You know what I mean?
Yes, for sure. Yes. What are some key macro indicators you have your eyes on right now, given your REIT's mandate?
Interest rates. We have our eyes on. We are, getting a better understanding on credit worthiness of tenants, trying to understand how to attract tenants that have a big impact in the new economy, digital infrastructure. So we have eyes on that. We are very focused on the existing tenant experience in our buildings, what their employees want, what is their future needs, how we can encapsulate that in our strategies, all of that. Yeah.
Okay. Can you share what is your current level of default payments on rent and who are they? What is your course of action?
Actually, so far we haven't seen a high or spike increase in any default payment. So it has always been on a very manageable level, very low level.
Okay. In the last FOMC meeting, the Federal Reserve was uncertain on continuing rate cuts. Won't this affect Prime adversely should this happen?
No, I don't think it's going to affect Prime adversely. So since the last FOMC and Powell comments, labor data came out saying that there's unemployment has increased. So the probability of Powell cutting in December was 90%. Then it went down to below 50%. Now it's almost at 65, 70%. So would there be a cut? But if there's not a cut, it's not like it's going to hurt Prime in any way adversely. But it's the tailwind. How strong is the tailwind behind interest rate cuts and what the Federal Reserve's tone is going into 2026? That's important to understand. Yeah.
Okay, yep, that's clear. Yeah, the next two questions are kind of a forecast, but I'll just read it out. Not sure whether you can answer those.
Yeah.
Is the new long lease signed come with positive rent reversion in place? And if yes, what is the percentage?
The lease that was signed is the one that is driving the high rental reversion actually. So you can roughly calculate the maths because 92,000 square feet was signed this quarter and the reversion is that amount. So 60,000 attributed to that. Yeah.
Oh, what about, I'm not sure whether this question is asking about the upcoming leases that are 1,000, the 150,000 in the pipeline. Yeah, do you have any a reply to that?
No, I think until it is signed, then we'll be able to announce it. Yeah.
Yeah, sure. Okay. And what's the guidance for the fourth quarter 2025 NPI? Does the REIT manager foresee it being higher than fourth quarter 2024?
I think in fourth quarter 2024, back then the occupancy that is contributing income is higher. So given as of now, we have come out and mention that 10.8% of the committed 2025 compared to the last year to be higher, just based on this kind of key metrics.
It's a lagging thing, right?
Correct.
Yeah, it's timing. Yeah.
Okay, so follow up to that, I think there was a reply to the earlier question. So you're referring to, would the absolute rental amount of Prime's portfolio, has it bottomed out?
Given the timing that those new leases have not signed, because there is still some expiries coming out, I would say that it will still maintain at about the kind of same level. For third Q 2026 onward, there should be some pickup when all the lease starts to, slowly kickstarting.
Okay. Since there's a flight to quality, are you looking to acquire more Class A assets?
Well, I don't think we have the means right now, but are we looking at assets in our target? Yes, we keep looking. I love the Dallas market. So it's in our sight, but not executable today.
Okay. Assuming the US government shutdown extends much longer, will this have any impact to Prime, and roughly how many % are leased to the US government agencies?
Yes. Okay. So typically these shutdowns come and go, right? So they are, but this one has prolonged beyond 6 weeks. Will it carry on the entire year? I think the likelihood is very, very low, right? But to answer your question in general, if this is prolonged for a year, 2 years, right? So the question is, how many federal entities do we have, right? So we signed a lease in Salt Lake City, a long-term lease over 20 years. What we define as General Services GSA, right? It's for the Attorney General for the District of Utah. Will they have the ability? So the first rent is due when, Cindy? The exact month?
Pardon?
The first rent of GSA is due when?
They are having about because it's a 20-year lease, it's
Yeah.
almost like a 20-month, yeah.
Yeah. So let's call it in 2026. I mean, I'm just Darren, I'm just speculating here. I'm not saying that it has any impact on Prime. I'm just drawing an extreme scenario for you. Will they have the ability to not pay rent because the shutdown carries on for another year to 2 years? Will it impact their ability to pay because there are closures in federal offices in Washington that release these funds to them? I mean, those are the extreme scenarios you can think of. But right now, as far as Prime is concerned, there's no direct impact.
Okay, that's clear. Yeah, under what market conditions would you consider selling assets or taking the REIT private?
We're not in any need to sell or to shore up a balance sheet or none of that, right? If I were to guess, we'll be more in an acquisition mode, right? So, but if some person wants to pay a good price for much higher than a valuation or whatever, I never say no to good opportunities, right? So that nothing is ever off the table. Privatization is not something on the table. Is that your question?
Yes. Okay. Yeah, so I guess that answers that. Okay, the next one is, do you have any performance-based incentives for management that tie directly to total shareholder return metrics?
Not in our current fee structure.
Okay. Yeah, okay. Let's go back to some of the other questions that has generally been talked about, but maybe like to clarify a little bit since you have a little bit of time. Yeah, with your 92,000 square foot of leases in third quarter, so what is the outlook for the remainder of this year and maybe next year, 2026, maybe because you already spoke about 2025, so especially given the upcoming tenant departure.
Go ahead,
No,
Cindy.
yeah, I would expect, I think it also has highlighted somewhat just now. So we expect the fourth quarter to be relatively flat, and first quarter, second quarter as well, and probably in the third quarter and fourth quarter, that's when we can slowly see the growth coming in. Because if we work backward, you will notice that 2026 third quarter and fourth quarter will be really the main square foot increase in terms of the lease start. So what I'm seeing now is the occupancy that actually contribute to the distributable income is actually only hovering at about 70%, basically 80.7 minus 10.8. Yeah, if that gives a rough guide.
Okay. The Utah attorney rent come in rental reversions. Okay, sorry. I think
I think it
there is
mean rent escalation. Yeah. So typically most of our leases actually do have rent escalation that is built in. So in the range of 2.5 to 3 or 3.5%.
Okay. Yeah, what is the total forecast dividend in 2025? Yeah, yeah, leave it to you.
To date, we have paid out by 1.2 plus 0.24. So just do a quick maths. So for the first 9 months, we have paid out 0.36 cents. So just based on the 0.24 cents that we recently have paid out, it translates to a distributable yield of about just under 5%. Yeah, 4% to 5% handle. Annualized, yeah.
Okay. What is a realistic occupancy rate that management targets?
When?
There's no timeline, perhaps. Just the end of this
No,
year.
no,
I mean, 85.
Darren, we want to bring this REIT up to 90 handle occupancy. That's our goal. And we have, like I was saying, we have a clear path towards that. And that's what we work very hard on every single day. And proper balance sheet, prudent spending of capital, signing long-term leases, negotiation. So operationally, that's what we are focused on. That's our goal, which in turn will lead to higher distribution for everybody.
Okay. Yeah. Perhaps this above 90%, can we likely reach it by the end of 2026?
I'm hoping, Darren, please give us good cheer and juju for that. Yes.
Okay. Yeah, let me just look through the question. I think most of it has been already covered somewhat.
Yeah, now you're repeating questions. Yes.
Yeah. So I think the rest of the questions have. Oh, there's one more that just popped up. How might changes in the US tax policy or REIT regulations affect your distribution strategy?
I think at the moment, there isn't any drastic tax policy or impending regulation that is coming into the pipeline. Even the big beautiful tax bill, a few months back has been dropped off as well. So at this stage, there's nothing that we are aware of that can potentially affect the whole REIT structure. Distribution strategy-wise is really like what we said, it depends on the visibility of the cash flow. And we are happy to say that the intention is to increase to at least 50% for second half 2025.
So these tax rules are grandfathered, very, very difficult to change. Important takeaway.
Okay. Yeah, let's answer this. With the recent 25 million private placement, how are you prioritizing the use of proceeds between capex, debt reduction, and potential acquisitions?
So the use of proceeds for this 25 million is actually made very clear that it majority goes into funding the capex and the TI. It's not for acquisition.
Okay. Beyond the upcoming refinancing, what cash reserves do you maintain to cover unexpected expenses or a prolonged vacancy cycle?
Typically, cash reserve we hover around like 20-ish million.
Okay. Okay, I think let's answer this up. When you register occupancy level, when the renting process takes 1 year, is it at the beginning or at the end of 1 year?
Well, the renting process, not in all cases, takes 1 year. But it's important you understand, let's say you start a conversation, 3 or 4 months later, we sign a lease. But if the lease is an 11-year lease, you're giving free rent.
Okay. So I think this question is asking when does that account for in the occupancy number, like the percentage? So is it at the point of signing or
Oh, yeah, signing.
yeah,
Yes.
okay.
That's why we are
Okay.
saying a contracted cash flow is coming a year later now. Yeah.
Okay, are you investing in prop tech or energy efficient upgrades that could improve your net operating income over the next 12 to 24 months?
Okay.
No, there has always been energy efficient upgrade has always been put into part of the planning whenever we do any AI work. So it's an ongoing process, like what we have also highlighted in our sustainability report. So all this like changing into LED light bulbs, which we also flash in our annual report. So these are ongoing continuous process.
Okay, yeah, let's answer
We
this one
work,
last question. Please
we
go ahead.
work very closely with a property manager, Lincoln Properties, which is an extremely well-known property manager in the US. And their DNA is on what you just talked about, sustainability, environment, efficient use of energy, and we spend a lot of time on that. The board gets updated on that every quarter, and we as management have monthly meetings on that subject. So it's a big topic for us. Yes.
Okay.
Go ahead, Dan.
Yeah, just one last one. With the unit price still trading at a huge discount to NAV, how is the team thinking about value creation or unit buybacks to narrow this gap?
Well, I don't think we're thinking unit buyback, but we are hoping to deliver results, occupancy end of the year. I think the analysts' reports that are coming out have been positive. The target price is changing. And the natural course of enhancing, is capital flow into REIT investors. Yes. So these buybacks and all are temporary kind of things, right? So, it's not like we've got, like Apple, $1 trillion laying in cash, right, for buyback. We're using it to increase occupancy. Yeah.
Okay, yeah. Thanks so much, Rahul and Cindy, for answering like over 40 questions. Yeah, I'll leave the last couple of minutes to you for any closing remarks you might have. So perhaps we move to Cindy first, then Rahul after. Yeah, thanks.
Okay, I think like what the last question has pointed out, is a huge discount to NAV, trading like 0.35 times to book now. So I think it's deeply undervalued now. And we can see the cash flow, a full-blown cash flow in 2027. So at the moment, the kind of distribution yield that we're paying is about just 4.8 to 5%. But this is going to grow. Yeah. Thank you for supporting us all this while, and we are very focused in delivering returns to unit holders. Over to you, Rahul.
Yes, no, firstly, I wanted to say thank you and for listening to our story and believing in us. And this is not, this is a journey, it's longer term. And thanks for giving us the trust. We don't take that lightly, and we will continue to work hard and deliver for all of you. So thank you for your time, and to be continued.
Okay, yeah. Once again, thanks Rahul and Cindy for answering my questions and for your time here today, as well as to the audience for all your questions. Yeah, so that brings us to the end of the webinar. Yeah, thank you
Thank
so
you.
much.
Yeah,
Thanks.
thanks,
See you
Darren.
again
Thank
soon.
you, Securities. Yeah.
Yeah,
Thank
thank you.
you.
Bye-bye.
Thank
Thank you.